Hey everyone, it's Tyler coming at you today with a fairly lengthy video, but this is kind of what the basis of the channel is about. Going over types of mortgages, different qualifications, what you might be looking for, what sort of questions you might have about what you might be eligible for. So just kind of a broad overview of really the most prominent loan types you're going to deal with. Again, these are probably the ones that you're going to be involved with and have questions about and things like that. Again, if you're going with a local bank or a credit union, a lot of times they're fairly simplified loans. You're going with more of a conventional type, which is obviously one of them. But to get into it, probably the first one that will apply to probably the least amount of people, but is definitely one of the ones that you hear a lot about, is the VA loan. Definitely the most niche because it's really only offered to veterans. There are some ways which, if you were a spouse of a veteran that was, died in the line of duty, and there's different ways that you can, take advantage of the VA eligibility if it wasn't specifically just yours. But if you're a veteran, you served active duty, or you were in the National Guard, or you're in the reserves for a set period of time, there's different qualifications depending on what type of duty you were in and what the situation was. But the loan itself is a very, very easy to qualify if you are eligible. It's a no down payment, fixed rate, simple, 30-year loan. I mean, I believe they can do 15 and different terms of it, but most people are applying for 30-year fixed rate. So, what's the best part about a VA loan? No down payment, obviously, is a huge, attracting factor, and that's, one of the best reasons, to go for it if you are eligible. Very low fees, compared to, say, an FHA. USDA is fairly competitive, but, as far as what they charge you to do the loan, like the funding fee is what they call it, which is basically like the VA's fee for basically, backing the loan. But that can even be waived. If you are a fully disabled veteran, they can waive that fee. Very easy to get into, very low debt-to-income ratios, very, very easy to qualify for. So again, definitely if you're a veteran, look into a VA loan right away. Make that your first choice. Again, obviously, look at everything else, compare and contrast, but that would definitely be, the best way to go in most cases if you're eligible for it. FHA is probably the most prominent loan you're going to deal with. I mean, it's the cookie cutter first-time home buyer, low down payment loan. It's very similar to VA as far as underwriting concerns and how lenient they are in debt-to-income ratio, which is basically determining how much you qualify based on your income. Very easy to qualify for. If you work with a mortgage lender, it's probably like the fallback. It's always, we specialize in some government loans, but FHA is usually the easiest one to get people going with. If they have the down payment of 3.5%, it's the easiest one to get qualified for and get, really stretch people's dollar, almost to kind of an amount that seems a little bit, over the top. But again, that definitely is going to be on your list of ones to look at. So what sort of different stuff, compared to VA and FHA? I mean, again, appraisals are going to be fairly similar as far as what they're looking for in a home, move-in ready condition, structure. They don't want any significant issues. They don't want a fixer-upper. There is a, FHA 203K loan, which is for specifically repairs. In this, we'll just discuss the basic loan, the 203B, which is, again, the cookie cutter, just first-time home buyer. So they do want it to be a primary residence, and they want you to be living in there for a year. But a lot of people do use this to purchase an original property, maybe refinance down the road, buy another one with another FHA loan. So they do only want you to have one at a time. FHA, there are certain situations where you can have more than one. But again, it's a fixed rate, typically 30-year. You can do 15, you can do 10, you can do 20. But 30 or 15 is really what most people are going to go for. Again, very lenient on debt-to-income ratios, very easy to qualify for. Just have to bring 3.5% down payment. There are still closing costs and things like that. But there's ways your loan officer will help you out with that as far as credits and getting it covered by the seller and trying to get you the home with just that. So definitely, again, FHA is going to let you stretch your dollar quite a bit. One of the ones that you don't hear about a lot, but is a great program, it's actually what my company specializes a lot in, is a USDA RD loan. So there's two basic types. One really disqualifies a lot of people. It's a very low income. It's called USDA Direct. It's subsidized, essentially. So it's for people in a very low income bracket. USDA has the most restrictions as far as the client, the property, the area. So there's a lot of things that go along with that. It is no down payment, which is what attracts most people. And again, it's fairly low fees. It's similar to VA and having very low mortgage insurance. And very low upfront fees compared to some of the other government loans. FHA has pretty high mortgage insurance, 0.85% of the mortgage amount per year. USDA is 0.35, so less than half. But USDA has area restrictions. It is a rural development loan, so they want you basically buying outside the city. There is a map online that lets you determine the areas. You can just kind of look at it. You can search specific addresses and things like that. And there are also area restrictions, income restrictions. So they want the household, again, it depends on how many people are in the household. It depends on the county. It goes by county. There's certain, little metro areas in the counties that can have different income limits, but typically somewhere between 75 and 110,000 for the household. So again, if you and your spouse live in the house, just you two, but if you have, if mom's living with you or Uncle Jim is living in the back, so they will include everyone's income in the household, so that can disqualify a lot of people. But it's definitely one to look into for first-time home buyers. If you're not looking in the city and you're looking and you don't make a ton of money, again, median income, moderate income, it's a good one to qualify for, because again, it's very easy to get into the home. Underwriting is a little restrictive. They're a little more conservative on the price point because it is no down payment. So they can limit your price range a little bit compared to like an FHA or VA loan. But again, definitely look into it, ask about it, see if it's something your area is eligible for, see if your household income might be eligible for. Because definitely if you can get into a USDA loan, it's a very, that's what I'd go for. Again, if not being a veteran, I would go for a USDA loan if I was, eligible and the property was eligible and I didn't have, other things going on. And the final would be just a regular conventional loan, Fannie Mae, Freddie Mac, conventional loan. So again, this is kind of the quintessential bank loan. This is what everyone you talk to, your bank, your credit union, they do conventional loans. You're going to see the most variance in conventional loans. Like I said, pretty much every bank does a conventional loan. Again, Fannie Mae, Freddie Mac, local credit unions will do them internally, but they're all kind of under the same kind of umbrella as a non-government insured loan. So a little bit higher credit score requirements typically. Again, it depends on the down payment. So the two big factors are your credit, obviously, and what sort of down payment you're bringing to the table, which will determine what sort of mortgage insurance is involved, if you need mortgage insurance, if you're over a 20% down payment, what your rates will look like, what your fees will look like. So there's a lot more variety in what you can get based on what you're bringing to the table as a borrower, basically. So again, it can basically be anywhere from a 3% down to 99% down. But your average borrower is going to do somewhere between 3 and 20% down. The advantage of 20% is you're not going to have any mortgage insurance. Every one of these loans, besides VA actually, is not, that one does not have any mortgage insurance. But every loan under like a 20% down payment, again, there's different caveats, lender paid insurance, things like that, but they're going to have mortgage insurance. VA does not. USDA has very little, through 0.35%, like I mentioned before. FHA is very high, 0.85%. Conventional is private mortgage insurance, so it's actually through a mortgage insurance company, just like a homeowner's insurance company. So you actually essentially get a quote for your mortgage insurance based on your risk. So very similar to what your rate is determined, based on your risk in your file. Your mortgage insurance will actually determine, by how much down payment you make, you have, what your credit scores look like, the loan to value, things like that. So, conventional loans will probably be somewhere in the middle, maybe 0.5%, maybe a little more, maybe a little less, depending on what sort of down payment you're bringing. Again, maybe none if you're bringing 20% down. So again, they're going to need a little bit more down payment, a little more credit score, a little higher credit score if you're not bringing much to the table. So again, us as a company typically are doing USDA, FHA, VA, and conventional loans, and the average conventional loan borrower is, we need about a 680, 660, 680 credit score with 5% down. Again, if you have a little higher credit score, maybe a 3% down, there's different little niche programs through Fannie and Freddie, which can allow you 3% down and can allow the lender to, basically have prices kind of set for them if they go through this program. So they can basically afford to give the borrower with a little lower credit score maybe a 3% or 5% down loan and not have a 10% rate on them. So again, you have a lot of options with conventional loans. There's a lot more variety. It's a lot more lender specified, what they can do, what the banks that are buying the loans from them can do, what sort of pricing is looking like. So you really want to run a lot of numbers with a conventional loan. If you're comparing, that type of loan, you probably want to check a few different banks. Again, a lot of the government loans are going to be fairly similar as far as fees go, and the rates should be fairly similar. Again, lenders can cut things here and there to give you a better deal, but you'll see a lot more variety in the conventionals. So if you're going that route, make sure you do your homework and know what you can get. So this was just, again, a very broad overview of the 4 basic loan types. Again, there's a lot of caveats to all of these. I'm going to go into more depth down the road here with each individual loan program, the different things involved with those, what sort of ratios are involved, what sort of underwriting specifications, little niche things that you should know about that you might determine one is better than the other for you. So if you liked this video, if you found any of this helpful, please subscribe, like the video, leave me a comment if you have questions. I'm sure a lot of questions will come up because of this video. Again, it was very broad, I understand, but I want to go into more detail and more specifics with each individual loan type in a separate video. Again, it's great to be here. If you need anything, just let us know.